Welcome to Talk Tickers. Today, we're diving straight into the first quarter 2025 earnings call for Saia Incorporated. We're here to bring you the critical insights, the stuff experienced investors like you need.
That's right. We'll hit the highlights first, give you that quick snapshot of performance.
And then we'll really get into the weeds, unpack the financials, the outlook, all of it.
Exactly. And we'll wrap up with our not financial advice segment. Got a couple of trade ideas brewing based on this call.
Always my favorite part. Okay, so the results snapshot for Saia. What are the headlines?
Well, they actually hit records for Q1, record revenue, record tonnage, and record shipments.
Records, okay. That sounds good on the surface. What's the revenue number?
Revenue reached $787.6 million. That's up 4.3% compared to last year.
And what's driving that growth?
It seems to be largely driven by the newer markets they've opened just in the last 3 years or so.
Okay, new markets pulling their weight. But I sense a but coming.
Yeah, there is a but. The operating ratio, well, it deteriorated quite a bit. It jumped to 91.1%.
Oof, from what?
From 84.4% in Q1 last year. So that's a pretty significant jump in costs relative to revenue.
Definitely. And earnings per share?
That followed suit. Diluted EPS came in at $1.86, which is down sharply from $3.38 year over year.
Wow. Okay, so record top line, but profitability took a serious hit. Let's dig into that revenue first. You said newer markets were the key.
Primarily, yes. They highlighted strong customer acceptance in those markets they've set up since 2022.
What about the older legacy markets?
That's where things look a bit different. They actually saw a slight decrease in shipments there in March. It meant the overall improvement from March into April was, pretty modest for the whole company.
So growth concentrated in new areas, while the core is maybe a bit soft. Were there other factors impacting the quarter? I heard something about seasonal trends.
Absolutely. They called out subseasonal trends in March and April. The estimated revenue hit from that alone was somewhere between $25 and $40 million.
That's not insignificant.
Not at all. And then there was the weather. They described it as more challenging and geographically widespread winter weather this year.
Right. I remember hearing about disruptions.
Yeah, it led to significant closures and limited operations. They specifically mentioned Atlanta, Dallas, Houston, big hubs for them.
And the impact on the numbers?
They estimated it added probably 25 to 75 basis points to that operating ratio, just the weather disruptions.
Okay, that helps paint the picture of why that OR jumped to 91.1%.
Yeah.
So record revenue, but weather and maybe softer legacy markets plus these subseasonal trends really squeezed margins.
Precisely, and that flows right down to the EPS drop we saw.
Let's talk pricing and yield. How did that play out with this revenue growth?
It's a bit of a mixed bag. Contract renewals looked pretty healthy, averaging 6.1%.
Okay, solid.
And revenue per shipment, if you strip out the fuel surcharge, that actually increased by 2.3%, up to $300.76.
So getting more per shipment overall?
Yes, but the yield, also excluding fuel, declined by 5.1%.
Wait, how does that work? Revenue per shipment up, yield down?
It reflects that classic inverse relationship between shipment weight and yield. Heavier shipments usually mean lower yield per pound or per hundredweight.
Ah, okay. And were shipments heavier?
Significantly. Tonnage overall was up a huge 11.0%. That came from a 2.9% increase in the actual number of shipments, but also a big 7.8% jump in the average weight per shipment.
Got it. So more shipments and much heavier shipments and length of haul.
Also up slightly, 1.9% to 95 miles on average.
So heavier freight moving slightly further. And you mentioned earlier the growth is skewed towards newer markets.
Exactly. And those newer markets are, like we said, less profitable right now. That drags down the overall yield figure. They did mention they're focusing on repricing business in those new markets now that they've onboarded customers, trying to align price better with cost and service levels.
Makes sense. They need to get those new lanes profitable.
Okay, let's pivot to expenses then. That OR jump tells us costs were rising fast. Where did you see the biggest increases?
Salaries, wages, and benefits were a big one, up 13.9%.
Why such a big jump? A couple of main reasons. Headcount grew 8% year over year, mostly from staffing those 21 new facilities. Plus, they had that roughly 4.1% wage increase kick in last July.
And the weather probably added to labor costs too.
Definitely. They mentioned extra line haul miles, more purchase transportation needed, extra dock operations. It all adds up when things get disrupted.
Speaking of purchase transportation, how does that line item look?
It was also up significantly by 14%. It now makes up 7.6% of their total revenue.
Relying more on outside carriers. What about fuel?
Fuel expense actually increased by 1.4%.
But didn't diesel prices come down nationally?
They did. So the fact that fuel costs went up tells you they were running a lot more miles, likely due to those network inefficiencies and maybe the longer length of haul too.
Okay. Any other big movers on the expense side?
Oh yeah. Claims and insurance expense surged by 23.4%.
Wow. 23%. Why?
They said it was due to both increased claims activity and higher costs per claim. So more incidents and each one costing more.
That's a tough combination. And depreciation.
Up 20.9%. That reflects all the investment they've been making, new trucks, trailers, those new terminals, technology upgrades. It all gets depreciated.
So putting it all together.
The bottom line on costs is that their overall cost per shipment jumped by 9.4%.
Okay, so nearly 10% more expensive to handle each shipment while yield went down. That really explains the margin pressure. What's the management team saying? How are they looking at this strategically?
They're acknowledging the headwinds, the macro environment, the weather impact, but the message is very much focused on the long term. They see these investments in building out the national network as crucial for future growth and value.
So they're sticking with the expansion plan.
It seems so. They reiterated that while these newer terminals are driving shipment growth, they're currently running roughly at break even.
Break even isn't great.
No, but the expectation, or maybe the hope, is that profitability ramps up as they build density and efficiency in those markets over time. They did say cost management actions are underway to align better with current demand levels.
How's their visibility on demand looking forward?
Pretty limited, actually. They mentioned customers are hesitant, citing macroeconomic uncertainty. And remember, shipments in their core legacy markets were actually down year over year in February and March.
Okay. Are they pulling back on spending at all? CapEx.
They are making some adjustments, primarily deferring some real estate projects. They said most of the equipment investments for the year have kind of already happened or are committed.
What's their long-term target for profitability, that operating ratio?
Still aiming for the 70s. But they acknowledge that'll require improvements internally and some help from the market itself.
The 70s feels a long way from 91.1.
It certainly does. Interestingly, they also talked about capacity. They estimate they have about 25-30% excess capacity in their network right now.
Is that good or bad?
They frame it as good, as crucial for handling future growth without needing massive immediate builds. It's capacity they can grow into.
Right. Did they give any color on specific customer segments? Any industries doing particularly well or poorly?
Not really. They described a generally cautious sentiment across the board, no major standouts, positive or negative, though they did hint that maybe volumes were a bit softer in coastal regions.
Okay. Anything else on the expense outlook? Interest, depreciation.
Yeah, they expect interest expense to stay elevated through the year, maybe peaking Q2 or Q3, depending on when some real estate deals close. And depreciation will also stay at a higher year-over-year run rate because of all the recent investments. Oh, one positive note on claims, the claims ratio actually improved slightly to 0.50% for the quarter.
So maybe some improvement on managing the cost per claim, even if the total dollar amount was up. Okay, that's a lot to digest. Heavy investment phase, dealing with weather, macro uncertainty, pressure on yields and costs, but underlying growth in new areas and a long-term network strategy.
That sums it up pretty well. Short-term pain for potential long-term gain, maybe.
All right, let's shift gears to our This Is Not Financial Advice segment. Based on everything we've just discussed about SIA, what's an outrageous but plausible trade idea floating around?
Okay, here's one thought. You look at this massive investment in their terminals. They're driving shipment growth, but are only break even right now. So maybe consider a long position in SIA paired with a short position in one of their competitors who is, much more reliant on mature legacy markets and hasn't been expanding your network as aggressively.
Interesting pair trade. What's the thesis there?
The idea is that if SIA can successfully ramp up these new markets, get them profitable as density builds, they could really start stealing market share. They'd potentially outperform competitors stuck with less organic growth potential. It's definitely a longer-term bet on SIA's executing that expansion plan.
A bet on the network build-out paying off. I like it. Okay, here's another angle, playing off that weather impact we talked about.
Yeah, that was significant this quarter.
Definitely. So another outrageous but plausible idea, like go long SIA, but this time short an index, maybe an ETF, of smaller, more regional logistics companies with less geographic diversity.
Okay, why that pairing?
The rationale is this. SIA's national network, yeah, it got hit hard this quarter because the bad weather was so widespread. But over the long run, that national footprint should provide more resilience against purely localized disruptions compared to a regional player who could get wiped out, operationally speaking, by a single major storm in their limited territory.
So it's a bet on diversification providing stability in potentially an era of more volatile weather.
Exactly. A bet that SIA's scale, while a challenge sometimes, is ultimately a strength against certain kinds of risk.
Two interesting thought experiments there. And just to hammer it home, these are absolutely not financial advice, purely speculative ideas to get you thinking.
Couldn't agree more. Always do your own homework. Understand the risks before making any investment decisions.
Definitely.
So that wraps up our deep dive on SIA Incorporated's Q1 2025 call. Record revenue, yes, but overshadowed by some pretty significant cost pressures, weather impacts, and that uncertain macro backdrop.
Yeah, the big story is really that investment in the national network. It's causing some headwinds now, clearly, but holds that potential for long-term opportunity.
The big question is, can they execute and turn that potential into profit? What do you think about SIA's strategy? Are those newer markets the future growth engine, or are the costs just too concerning right now?
Lots to mull over there.
Indeed. We encourage you to dig deeper yourself. Thanks for tuning in to Talk Tickers. We'll keep unpacking the earnings calls that matter most to your portfolio.
Until next time, keep those tickers talking.